On today's edition of Women and Money Montreal, we're going to be talking about all things ETFs and index funds. What are they? Why are they so popular? And which is the better investment option? I know over the last 5 to 7 years or so, they become increasingly popular. And the question is, why? I get asked this a lot. Which is a better investment option? Or sometimes I hear I need to invest in index funds or I need to invest in ETFs. And my question is always, why? So we're going to go over what they are, how they started, where they come from, and kind of get a better understanding of how you should be investing your hard-earned money. So just to give you a little bit of a background, index funds have actually been around since about the mid-1970s, index funds as we know them today, and ETFs, or exchange-traded funds, were created back in the early 90s. Now, before I get into what they are, there's some terminology that we need to understand to fully grasp what exactly these types of funds are. So first things first, we need to know what a stock market is. So what is a stock market? A stock market are actual markets. Nowadays they're virtual, but actual markets where you could buy and sell shares of publicly traded companies. Here in Canada, the biggest stock market is the Toronto Stock Exchange. So all the big Canadian corporations, if you yourself as an investor want to invest in any of these companies, you could literally buy shares of these companies on any self-directed investing platform. So for example, if I wanted to invest in RBC, I could go onto either my bank's self-directed platform or any other platform that's out there and buy shares of RBC. When I'm comfortable with the profits that I've made, I could also sell them. In the US, the biggest stock exchanges are the New York Stock Exchange and the NASDAQ Stock Exchange. But there are many, many, many stock exchanges all over the world. And literally, stock markets or stock exchanges are where you buy and sell shares of publicly traded companies. What is a stock market index? So a stock market index basically gives a valuation of a segment of stock markets. So for example, here in Canada, the biggest stock market index is the S&P TSX Composite Index. And what it is that it gives a valuation of most of the companies listed on the Toronto Stock Exchange. So when you check out how markets are doing, usually what you're looking at are stock market indexes or stock market indices, because they give a valuation of a segment of the stock market or various stock markets. In the US, for example, you have the Dow Jones Industrial Average, which gives a valuation of a segment of the biggest and oldest corporations in the US. There is also the S&P 500 in the US. The S&P 500 gives a valuation or a report card or a grade, if you will, of how the Fortune 500 companies in the US are performing. There's also the NASDAQ Composite Index, which is an index that gives a valuation of most of the NASDAQ stock exchange. So just to make things a little bit confusing, the NASDAQ has both a stock market and there's also an index. So basically, an index gives a valuation on a basket of companies listed on a stock exchange, listed on stock exchanges. So where do ETFs and index funds fit in? So an index fund literally is a type of investment that follows the performance of an index. So I, as an investor, might say to myself, oh, Lynn, I really like the way that technology is going. I would like to invest in NASDAQ index funds. If I'm investing in NASDAQ index funds, I'm investing in something that follows the performance of the NASDAQ index. So if the NASDAQ Composite Index goes up, my returns increase. If the NASDAQ index goes down, I'm going to be at a loss. If there are no real changes, then it stays the same. Index funds never outperform the index. So you could never, as an investor, make more money or have a higher return than what the index is actually, how the index is actually performing. Why do people choose index funds? Because they're passive. You don't really have to think. And you could kind of do a check-in every so often, and you could do a check-in every so often to see how your investments are performing. And there's nothing to really do. Indexes are meant to increase over long term, and generally speaking, index funds do really well. Companies that do list on stock markets, they work really hard to get there. They pay a lot of money to get there. So the whole idea of becoming a company that's listed on a stock market, you want to grow. You want to grow because you want your share price to increase and you want to satisfy your shareholders. So indices or indexes in general, they are a good investment for those who just don't want to think too much and don't want to check in on markets every single day, because if you're investing for the long term, they are going to grow and you won't make money. However, you will never outperform an index, so you're a little bit limited, but you'll still make money in the long term. Exchange traded funds, on the other hand, were, like I said, created back in the early 90s. And they were created to compete with both stock traders, so investors who buy and sell and do a lot of self-directed investing. They're meant to compete with those people, as well as mutual funds. So in the mutual funds world, there's kind of like this anti-mutual funds movement where investors don't want to pay fees to an advisor. They don't see the value. And, understandably, investors want to keep as much money in their pocket as possible. So exchange traded funds were created to almost mimic what a mutual fund is, which is a basket of a certain type of investment. Exchange traded funds you could buy and sell just like stocks. So you yourself, if you have a Wealthsimple account, if you're on Questrade, if you have a self-directed investing account with your own bank, you could go ahead and buy and sell ETFs just like you would shares in a company. Why has it become popular? Because it's the whole do-it-yourself movement. People like being able to invest themselves without having to pay an advisor. It's not that ETFs are without fees. Trust me, all these platforms, they do charge a fee somewhere. Some are clearer about it, others are not. But all these are businesses. These are financial institutions. So somewhere they're making money. And like I said, they were designed to compete against advisors and to provide an option for investors who do not want to lose any of their profits because of advisor fees. Now, ETFs are a little bit more diverse. Index funds, like I said, directly follow an index, so you'll never outperform the index. With ETFs, they're basically a basket of investments and they could come in many different forms. You could have an ETF that follows an index, right? So you can have like an ETF that's an index fund versus an ETF versus an index fund that's in the form of a mutual fund. You could also have a basket of commodities. There are gold ETFs. There are ETFs that are into precious metals. There's even Bitcoin ETFs that are available. So you could, it basically tracks the performance of those commodities. There are also sector-based ETFs. So just as an example, I had mentioned this during our Zoom. In Canada, there's a video game ETF. So if you're interested in video games and believe in the eventual returns that video games will bring, this is an option, but it's very sector-based. That's just the video game ETF is just an example of a sector-based ETF, but there are many different sectors. And you could also invest in ETFs that are invested in a basket of stocks. So they're more diverse. Both ETFs and index funds are passively managed, so the fees tend to be low. ETF fees are much lower than index funds that come in the form of mutual funds. But people always ask me what's the better option, and what I always say is, at the end of the day, you have to look at what you're invested in and what your overall return is. And the disadvantage of the do-it-yourself method is that they're made to cater to people who don't have much investment background, and they take for granted that people are, you go online, let's say with Wealthsimple, and you're filling out a form, and then the algorithm tells you what type of investor you are, and then the platform spits out fund options based on the questionnaire you just filled out. A lot of times, for people who are not investment savvy or don't have any experience, a lot of investors don't even know what they're invested in. And at the end of the day, whether you're working with an advisor or using a platform, everybody should have a general understanding of what they're invested in. And like I always say, nobody ever complains when things are going well. Everybody's happy when they're making money. Where you have an issue is when, like in 2022, when there was a downturn in the market, that's where you have an issue. And if you don't have a general understanding of what you're invested in, no bueno, that's not good. Which is better to invest in, ETFs or index funds? It's really not a question of what's better. It's what do you expect out of your investments? Index funds, like I said, are a great option if you just want to park it, leave it, and wake up 20 years from now. You will make your money. What you're missing out on is the potential growth in different sectors along the years, but you will make your money. ETFs, like I said, you can do it on a self-directed platform, which is what they were designed for do-it-yourself investors. You could also work with an advisor and invest in ETFs. There's more diversity, but you could also invest in ETFs that are very volatile or sector-based, where there's no diversification. It's just that there are more options. One is not better than the other. What you really need to ask yourself as an investor is, what are you invested in? What do you expect out of the returns? And whatever fees you're paying, are you getting what you want out of your investments? Someone had asked me during the Zoom, is it even necessary to invest your money for retirement? And my answer is, yeah, absolutely. Because if all you're doing over the years that you're working, if all you're doing is putting money aside, whether it's into a TFSA, an RRSP, and you don't invest your money, by the time you reach age 65, all you're going to see in your account is the money that you personally put in. The goal of investing is that, yes, you contribute, but your money is growing for you. So it's really important to learn how to invest as early as possible. And even if you don't learn how to invest in your 20s, 30s, 40s, even if you're in your 50s, it's not too late to invest. The key question is, when do you need to start withdrawing money, and how much of your portfolio do you need to start withdrawing? And why have they become increasingly popular? Like I said, it has to do with the do-it-yourself investing. People want to invest, but they don't want to be proactive. Is it better to pay a higher fee for actively managed portfolios or actively managed funds? Again, it depends from person to person. At the end of the day, if you have a portfolio that's actively managed, you want to make sure that the advisor that you're working with satisfies your needs as an investor. I know that there are some people who don't want to know anything about what their money is doing. They don't want to know how they're investing. They don't want to know anything about their investments. And again, everything is fine until it's not fine. So I encourage everybody who has that type of mentality, look, you don't have to know the fine details, but have a general understanding of what you're invested in, so that if something happens in the world and your funds, your portfolio crashes, it doesn't come as a surprise. Oftentimes when I meet with clients, especially when they're coming from like a Wealthsimple type of platform and they have no understanding of how investments work, oftentimes they're rather surprised of what they're invested in. And then they're also disappointed because they realize that that they have no returns. And during COVID, a lot of money was made. So if you invested at the beginning of COVID, you did really well. And you're still on top today, even though 2022 was a lousy year. Investing is for the long term. It's not about timing in the market. It's about your time in the market and understanding that it's about patience, and you just have to stick with it. So just to close, I get asked often, why should I work with an advisor if I could just do it on my own? I encourage everybody to do it on their own, but at some point, just like with every other do-it-yourself platform, taxes you could do on your own. You could write a will on your own. You could draft contracts, business contracts on your own. Everything is fine until it's not fine. I know the value that I give to my clients as an advisor. Not every advisor works the same way. So at the end of the day, when it comes to your money, whether you are working with an advisor or using a platform and doing it yourself, never blindly give everything up to the advisor or the platform. Know what you're invested in. ETFs, both ETFs and index funds, are great options. It boils down to what you want to do with your money, what you expect as a return, and the satisfaction that you get out of it. Because at the end of the day, all of us want to reach retirement with money and some growth, and we want to have this idea that our money has been working for us. If you have any questions regarding ETFs or index funds, if you would like to do an investment review on your current investments, my contact information is going to be at the end of the video. It will be more than my pleasure to assist you.